Good afternoon and welcome to the latest Shift Collective webinar, where we're going to be covering what good looks like in regulatory hosting. My name's James Hogbin. I'm the founder and CEO of Fingerprint Supervision, a vendor in the space. And joining me today are two true industry legends, Andrew and Rebecca. Rebecca, would you like to introduce yourself and let the good people know all about you?
Thanks, James. Good afternoon, everyone. Delighted to be here. I'm the CEO of Bovill. We are a regulatory consulting firm. I was recently based in Hong Kong. For the last 7 years, I've been out in Asia. I've been working with Bovill for 16 years, so the rest of my career has been based here in the UK. So I'll bring a bit of an international perspective to our conversations this afternoon.
I'm Andrew Shrimpton. I'm the chair, or SMF9 as it's known in regulatory parlance, of IQEQ RegCom. So we're the largest regulatory host by number of ARs, in the UK market. I'm also chair of our rapidly growing compliance consultancy business, which helps financial services business, especially fund managers, get directly authorised by the FCA and then supports them as they thrive and grow.
Thank you. So, a little bit of background about regulatory hosting and the principal regime. Last year, the FCA undertook a consultation to understand a little bit better and put some rules around principal firms and regulatory hosts and that sort of thing. And they came out with updated guidance earlier on this year. And what that guidance does is it sets out the framework for principal firms, authorised representatives, introducing authorised representatives and all of that sort of thing. And obviously this is a huge sector of the market. Now, as a direct quote from the FCA, just to get us going, within the consultation paper, there was a question that the FCA asked, which was, what do you consider the harms and benefits of the existing regulatory hosting model? And in the policy guidance they've just issued, they say, point 4.9, the majority of respondents agreed with our assessment, that's not my assessment, that's the FCA's assessment, to be clear, agreed with our assessment that there is harm associated with the regulatory hosting model. They considered, that is the FCA, considered that regulatory hosts often exercised poor oversight over their ARs, which might lead to harm. They cited a number of reasons for this. I could read the reasons, but the general thrust of it is that the regulatory hosting business is kind of on the back foot as far as the FCA is concerned. Obviously not IQEQ, who are an industry-leading provider. It would be interesting to hear your opinions on whether you agree or not with the FCA on their opinion. Andrew.
Well, I think 3 or 4 years ago that was true. And they did thematic work and they found that there were a lot of unmanaged conflicts. So a lot of entrepreneurs had come into the industry, they were the CEOs and they were the head of compliance. They didn't really manage that conflict, grew the industry very rapidly. But I think as a result of that thematic work, which took place in 2018, I think the Dear CEO letter was early 2019, they made it very clear that, if things didn't change, if firms didn't invest and enhance their governance, that they had to do that for the industry to survive. So I know that we've done that at IQEQ. I mean, for example, we've got a separate CEO and SMF16. In fact, we've got 2 principal firms, so we have a different one for each principal firm. SMF16. I'd say when I arrived 3 or 4 years ago, we had 2 senior experienced people, and it's now up to about 8 or 9 at that level, just below the CEO. And then we've invested in people below that. We've invested in technology, especially on the sort of screening sanctions side. So I hope others have transformed ourselves. So I think we'll now address that firm. And I feel confident in saying that the ARs on our platform are monitored and have more oversight than if they were directly authorised by the FCA. Because we can have the resources from the fees to make sure that that each monitoring analyst, for example, doesn't have too many ARs. They can get to know them. We can have the technology. Whereas if they were directly authorised with the FCA, they'd just be what's known as a portfolio company. So they'd only be subject to occasional sort of thematic work and letters going out and looking at the returns. So I think that has been transformed for the best players in the industry. I don't know if it's the whole industry, it's certainly for the ones that have listened and invested since then, that's been transformed. In terms of the benefit, there's a really important benefit that I think the industry's got to do a much better job of explaining. So I'll put this in terms of the Financial Services and Markets Bill, which has created this new objective for the FCA, to grow, to help UK growth, maintain competitiveness. So this is a huge change, and it's very significant that they have that. And there was a senior director from the FCA talking about how they were going to do this at a recent conference. And one of the ways they mentioned was the regulatory sandbox. They pointed out how this regulatory sandbox had helped the UK be the leading centre in Europe for fintech innovation and second only to the US globally. That's the way they put it. Well, that's the big benefit of certainly regulatory hosts for investment managers. It is in effect a regulatory sandbox. It's a regulatory incubator for alternative asset management businesses. And I think it's a huge reason why, again, to say that phrase, the UK is the leading, place for alternative asset managers in Europe and second only to the US. So I think there's a huge benefit there, and we need to sort of get that message across. Although that only works though if we're providing institutional quality compliance support to those startup funds. But as I say, I think certainly we are, and hopefully some other players have made that investment in the last 3 or 4 years and are also doing the same.
So, Rebecca, obviously we're going for what good looks like, and IQ-EQ are good. We're talking about separation of responsibility. We're talking about appropriate technology. We're talking about segregation of the business into different pools of risk of the ARs. You're a consultant. You consult other regulatory hosts and even people maybe choosing to become an AR. What's your take on what good looks like in this industry?
So we have a slightly different perspective of the world. So we have an incredibly broad range of clients across the sector, including principal and AR firms that are not in that regulatory host category. And indeed, we have regulatory hosts on our books, and I agree with Andrew. I think there's still a big range of quality out there in the marketplace. I think the regulator has been working steadily since the Dear CEO letter, and is still working on their supervision behind the scenes. And we see and seeing increasing number of, for example, skilled person requirement notices coming out, which are targeted at the principal AR firms and targeted at the regulatory hosts as well.
So when you say you see them, you're involved in assessing
our
them,
desk.
or
They've crossed our desk because Bovill is on the skilled person panel, so we're quite well known in the market as a potential skilled person. So we see that supervision activity is live and happening.
And these are also known as Section 166s,
Section
right?
166s, yes,
Perfect.
that's quite right.
Thank you.
So I think that there is still quite a lot of work to be done to get everyone to the same level of quality. I think there are still some smaller firms, some firms who haven't had that realisation that investing in compliance is a positive benefit rather than not investing in compliance should attract people to their platform or their network. And I think that's still working its way through. I think the other big issue and the other big pillar to the policy statement is the regulator doesn't have enough data. Increasingly, the regulator is open about being a data-led regulator, as lots of regulators across the globe are being much more data-led. And the simple matter of the fact is the regulator doesn't have enough information to help their supervision. So we know that in December, and it's in the policy statement, and it was also said at recent PIMFA conference by one of the FCA spokesperson, There's a Section 165 data request coming. What's that mean in practice? Well, a questionnaire coming out to all the principal firms to gather a lot more detail. It will include a tick box to say, are you a regulatory hosting firm now? So firms will have to determine and declare whether they're offering that service. But lots of other information will have to be shared around the existing controls that you have in place, the level of monitoring, and this will just give the regulator much more real information to help them with their supervision efforts and make sure that they, as they put it in their own words, spot any harm that's being conducted in the marketplace still now today.
So that data point is actually very interesting, and Andrew and I were having a broad-ranging discussion slightly earlier about this. And within the guidance, the FCA has always seen principal firms because it's counted up on its register who's an AR, they're a principal. And they don't actually know what a regulatory host versus what a principal is in terms of data. So within the guidance, there is now a definition of what a regulatory host is. And a regulatory host is a compliance company with no business purpose within the lines that the ARs exist to do. So if you're a large mortgage bank and you have ARs who sell your mortgages, you have a primary principal purpose of selling a mortgage, and so therefore you are regulated to sell mortgages, and your ARs are regulated along with you to do that. And the regulator seems to be happy with that as a, we know the risk. Whereas with a regulatory host, the regulatory host grabs a bunch of permissions and rents them out ad hoc to a whole load of ARs. And I'm just wondering about both of your opinions. It strikes me that this is the initial step of the regulator saying these two are different. We've got principals that are actually in the flow of the action, and we've got regulatory hosts that are mini sandboxes. And I just have a concept of the fact that this is the start of seeing the market split. And we will end up with principal firms with ARs in a different regime from regulatory hosts with ARs. And the data has started now. What does that?
Yeah, no, I agree. I think we do need to split the two out. So the only data we've got to estimate regulatory hosting at the moment was the statement made in 2019 when they issued the Dear CEO letter. I mean, at that point, they call them principal firms for investment managers, which is very much what we're in. And they said there's 1,000 ARs, over 1,000 ARs, rely on these principals for investment managers, and they talked about them being AFIMs and MiFID managers, etc. And they said that there was 340 hosts. So I mean that's quite interesting in a way because we've got 100 out of the 1,000, so 1 in 10 are with us. And then I think there's some other players that are half our size. They have 50. It's about
do I
half
do my
a dozen.
D2C thing?
Yeah.
There are other players in the marketplace as well.
There's about half a dozen of those, but there's 340 hosts. So that suggests there's a lot of regulatory hosts who just have one AR. And, the only place
do they not just become principals that have a mate that's working for them? So the FCA is trying to differentiate between the firms that, as a business, are saying, we're going to the FCA and applying for these permissions to rent them out, and we're an investment manager, and that desk, we want to capture some of the economics, so we'll offer to be their compliance and middle office.
Yeah,
Or it could be corporate finance. I think there are different flavours as well.
Right.
I think maybe that's the intent, Andrew, but I'm not sure if that's where it will end up, because I think the formal glossary definition of regulatory host, as you say, James, it doesn't mention the investment management piece for starters, so it's not only targeting those, if we call them the Dear CEO letter target audience.
Yeah.
I think it's much broader than that, and we do see other flavours and other types of regulatory hosts. They're calling themselves regulatory hosts on their website and publicly advertising themselves as regulatory hosts, but actually they have a very diverse set of ARs on their platform or on their network, which span, investment management, trading, dealing, all sorts of different flavours and types of business model.
So are you saying that as well as those 1,000, there might be another 1,000, or maybe it's up to 2,000 or 3,000 that are ARs of regulatory hosts, really, and that principles for investment managers, they called it. That's just a subset of regulatory hosting. Yeah, no, that
It depends
that
what
makes
they do in the
sense.
retail space. Because remember, of the 40-odd thousand ARs, 35,000 of them are in the retail space.
Yeah.
And you get big networks of umbrellas that IFAs join and pension salespeople join and credit car finance people join that will, under the terms of the guidance, become regulatory hosts.
Yeah.
Because they don't have a purpose of selling a pension, they have a purpose of providing a regulatory umbrella to a whole load of people in car dealerships selling car finance, or a whole load of IFAs that are selling IFA products. They're not an IFA themselves, they're just providing an umbrella to it. So I think that the FCA is trying to move the two apart, because I have a feeling, and again, I'm interested in your feedback on, I think that the regulatory scrutiny of a regulatory host will be much higher than of a principal, because a principal has its own regulatory regime. You're selling insurance. The FCA know how to regulate insurance providers, and an AR selling insurance is just a bit of paperwork more with some monitoring. But if your purpose is purely regulation for regulation's sake, I can see the FCA really bearing down on that and saying, you're going to have to be absolutely crystal clear about roles and responsibilities. Your systems and performances are just going to be enormous. Or am I reading it wrong? You're an ex-regulator.
No,
And you're in the day-to-day of consulting. So
I think you're going down the right track there. So I think they said there's 36,000 ARs, and you're saying there's not 1,000 ARs on reg hosts. It's more like 3,000, say. So let's say they're going to split it between the 33,000, which are the old-fashioned original, insurance company ARs, and then we have 3,000 ARs, say, on regulatory host, 1,000 of which are to do with investment management. I think you're right, and I think the only point of doing this notification that I can see is to enhance, supervision. And certainly that bit that I say, this asset management incubator, asset management sandbox, if the FCA want to preserve that, then they need to do a lot more supervision, and they need to have a specialist team, and they need the biggest players probably need relationship management. I mean, it's very similar actually to the noughties and hedge funds actually. Just going back in my own career.
Arrow 2, here we are.
No, but I wrote this paper on hedge fund regulation. It said, we need a specialist team to supervise hedge funds, and then I got that job that I'd written for myself.
There we are.
And then we added private equity, and we ended up with 40 to 50 of the biggest hedge funds and private equity. I mean, I think the FCA need to go down that route. They need a specialist team to focus on supervising the regulatory hosting sector, really, which is separate, as you say, from the typical, the old ARs that are part of insurance companies, etc. I don't know if you agree to that.
I do, and I think that's the intent, and I think that's why there's an additional tick box on the data gathering, and for the appoint a new AR form going forward will be a new tick box to say, and the new obligation to say you will be a regulatory host. But I do wonder, as the supervision works its way through, there will be other thematic efforts looking at the market, which actually may focus on, well, it's back to the principals have to assess the potential harm. I think the regulator will quite quickly get better at assessing the potential harm once they've seen the different business models and they've got more data that they can use. So there I'm thinking, for example, where you know that there's a retail market, where you know the size of the AR is very large as compared to the regulatory host or as compared to the principal firm, I think they will then start to target supervision in slightly different areas. Because, we're talking largely about a wholesale retail split here, which doesn't really make common sense if the regulator's saying they're going to have greater supervision and oversight over a wholesale player versus a retail player. So I think there'll be other factors which will come in.
I think there might be a retail wholesale split in regulatory hosting because they carry different risks.
Yeah.
And if we imagine that the FCA are concerned about outcomes for retail investors predominantly, which they seem to be, then if you were a regulatory host within the retail space looking after a whole load of IFAs or pension salespeople or life insurance sales guys, you will find that your paperwork, your KYC, all of the obligations that you had as a regulatory host in that area are markedly different from a regulatory host in the wholesale area that is effectively regulating mini hedge funds and infrastructure funds and just walked off the desk of a investment bank and want to carry on with the strategy type funds. Because the outcomes for the individuals are markedly different. You know, you can't get into wholesale ARs unless you're a professional or eligible counterparty. Whereas you can get into retail retail regulatory hosts fairly easily by answering a WhatsApp or something. So, Rachel, if I was going to start a regulatory host right now, and I came to you as a new client, what would you be saying, well, you're really going to have to be looking after those bits of your business?
So back to, there are lots of different flavours. So the first place to start is assessing the regulatory risk. So that involves a good understanding of the target market, a good understanding of what the service offering is going to be. I think there are some basic building blocks which it's clear are now expected, which is set out in the policy statement around the expectation of good due diligence when you first take on the ARs. And we're starting to see a picture of real practical examples of what that should look like. So assessing, back to this statement of the principal must assess what is the potential harm of that AR. That needs to be factored into the due diligence to start with. So needs to think about the prudential capital requirements that the principal might need to hold to cover the activities of that appointed rep. But also thinking about the proper AML risk that might be presented, for example. So I think the regulator is accepting of the fact that you may codify your due diligence to make it straightforward and repeatable, so have it as a process-driven take-on, but it needs to be well designed. It needs to be bespoke to the specific regulatory risk that that platform is offering to take to the market. But the other side to it is once they've taken on their ARs, then there's the ongoing monitoring as well. And that, again, needs to be carefully designed. It was interesting to hear what Andrew was saying about you think that your ARs are better monitored than they would be under the equivalent of regulatory supervision. But I think it comes back to the same principles as when you're designing a good compliance monitoring framework. It's understanding where the regulatory risk lies, how great that is, and then point the resources and have adequate resources to point at those regulatory risks that there are.
And what would good look like in your outside looking in opinion? Because you deal with people that are directly regulated and people that, and I'm asking you to take on the mantle of advising a regulatory host. It strikes me, and always has done, that to become regulated, you've got one big exam to begin with, getting whatever it is. So you copy a business continuity plan, you copy a compliance handbook from a consultant, you pay your money, you wait your time, you're in. Then they never talk to you again, ever. I've never, ever, ever, other than one hedge fund, ever seen the regulator. So I'm with Andrew on this. I think as a regulatory host that do regular oversight, what are you doing? We're monitoring you, we're looking at you. I think they do a clearer job of oversight. Whether that oversight is appropriate or asking the right questions or whatever, I'm sure it is in most cases. But what would you say good look like for a regulatory host as opposed to a directly regulated firm?
I still think it's quite similar to as if the firm was directly authorised, insofar as, yes, that's the first scrutiny that you would need to get through with the regulator.
Sorry, only scrutiny you'd need to get through with the regulator.
But to manage your risk can come from many different, it can crystallise from many different places. Yeah. So it could crystallise from a complaint from one of your customers. It could crystallise from one of your peers taking a complaint to the regulator. So I don't think you should be, complacent in thinking that, okay, we've got through the regulatory scrutiny of authorisation, so therefore it's not worth investing in compliance from that point forward, because actually, it's a bit like the analogy with speeding. As long as nobody catches me, speeding and going over is it okay to go over the speed limit? but there are still
No, it's not. To be
obligations.
clear,
So it's not.
it's not okay to go
That's
over
the
the
bit I
speed
chose at
limit.
the end. Definitely not.
That's not professional advice in any way, shape or form. Don't do it.
Because you still have to meet your obligations, and
Yes.
good compliance is worth investing in, because good compliance is about running your business in a commercial and a professional and a risk-sensitive way if you do it correctly. So the ongoing monitoring is actually helping you spot risks before they crystallise. So, the point I mentioned earlier about saying, have you got enough capital to support this business? Well, again, that's just looking at it through the capital lens, but have you got enough cash and balance sheet support if something goes wrong? You want to be able to make sure you have a sustainable business. So actually for me, compliance is good common sense, it's good business sense, and so that's why I'd say it's good to invest in compliance, and I'll end up in the same category as Andrew and agreeing with Andrew.
And so, Andrew, just imagine I'm a highly successful businessman. It's a leap. I'll take that. It's a leap. And I'm looking to trade a strategy that I was successful in my large franchise bank. Here I am at your door. What checks are you doing? What does good look like in terms of the processes you put in place? What could I expect as a normal investment type?
Yeah, I mean, the easiest checks to do at first are checks on the governance and the complex management, because the information on the senior manager roles is in the public domain. It's on the FCA register. So as a minimum, a regulatory host needs a CEO and they need an SMF 16, two different people. And some of them don't have an SMF1, and they should really. So you need an SMF1, you need an SMF 16, two different people.
Who's the MLRO?
Then you need a separate person.
Yeah, you need.
To be.
Yes.
I mean,
Is that a 17 nowadays?
That's 70, SMF 17, yeah.
Yeah.
So with sanctions risk going through the roof, as we
Yeah,
all know
yeah.
why, you need a separate SMF 17 now in a regulatory host. That SMF 16 should not have too many ARs to be responsible for.
So you would suggest an SMF 16 is constrained to 10, 20, 30 ARs, and then you need another one.
I'd put
into
it
that,
higher than
or-
that. I think an SMF 16 can probably do around 75, something like that, higher. But you've got to make sure that that they're not over capacity.
Yeah.
Then you can have an SMF 9, which I'm as well. That's probably belt and braces, but that can provide extra challenge to the SMF 1. So that's on the governance side. You can do that. It's all in the public domain. You can do your own little desk-based research there. I think when you meet the regulatory host, you need to ask them about their monitoring and what their resources are for monitoring and the skills and experience. So each monitoring person should not have too many ARs. So we don't think they should have more than 10. It should be that's the kind of
And are
cut-off
they
for us.
thematically selected? So you would look for a monitoring executive that had 10 of the same, or 10 utterly different to get their understanding across different business lines?
I mean, you do need different skill sets. I mean, for us, we're huge in PE, private equity. Venture hedge funds. So there's a lot of similarities there, but you do need slightly different skills for hedge funds compared to PE. So it's not a big issue for us, but yes, you do need people to kind of specialise in that. So and then you need to ask them, well, how do they maintain that rate as they grow? So we track ahead how many ARs we're going to have in the future, and then if we can see, you've got to anticipate we're going to go through 10 per monitoring executive. So we then go out and hire another one. So you've got to have all that nailed. And that is something that the FCA have talked about in the papers. You've got to have adequate resources to do the monitoring properly. You need to do so as soon as you go through the onboarding. You've got to do a risk assessment. Again, I'm sure you do this for authorised firms. You need a structured risk assessment with lots of factors, so you know exactly what the monitoring needs to look like. You need a structured monitoring program. You need working papers. You need to do that at least quarterly and give a findings report back to the AR. So you can ask questions about all that. And then I'd say the third area is just the onboarding. So, the onboarding, you need to do screening and, lots of due diligence. I mean, especially at the moment, with, as I was saying, with sanctions risk going through the roof. So, this year, the most common reason we won't onboard someone is if they've got a Russian connection, as a UBO of the AR, or they've got a Russian client, all that kind of stuff. So, you've got to have great onboarding, and that should be reasonably intense. I mean, we do get some AR saying, "Oh, well, you seem to ask more questions than we were expecting," or what we've found in the past with others. Well, you should.
That's what good looks like.
You've got to be prepared to have quite an intensive. As they say, you've got to give 30 days notice there, and that is a lot on the individuals actually. So the individuals who want to be directors or partners or CF30s, they need to be prepared to have scrutiny of them and subject to screening. So, but I think they're the three main things. So it's governance, ongoing monitoring, and then the onboarding oversight.
So with things like MiFID that were designed to open up the market to loads more people and the rest of it, it strikes me that this policy statement is driving an almost binary approach to these things. There is no longer a tiered approach to regulatory hosting depending on the financial appetite or risk appetite of the potential AR. It strikes me that what this policy paper is doing is you're either a good reg host or you're not. There is now no longer markets within regulatory hosting. You're going to pay your, I don't know, $5,000 a month person to the reg host, or you're not. And that is now the market. There is a reg host or there isn't. There is now no shades of grey, other service offerings that could be offered under this arrangement. Is that?
I think there probably are shades of grey.
Okay, well, explain where you think they are.
Because I think, as I keep coming back to, there are many different sizes and shapes of regulatory host out there. And we can talk about the definition for ages because that's something we'll get asked. But when you come down to the practicalities, I think there is still a spectrum in terms of the approaches that firms are taking. And it does depend on a few different factors: the size of the offerings, so how many ARs they have, the complexity of the different markets that they're in. So even as Andrew was explaining there, with an investment management regulatory host, even within then, there are different strategies that those ARs could be following, and that will bring in different obligations and different requirements in terms of the good compliance monitoring that you need to have in place as a response. So if a regulatory host is only focused on one particular strategy, so hedge only, for example, then the controls would need to be very focused on making sure that the regulatory risks within that, so the best execution monitoring, the looking at exposures in the market.
And the risk monitoring at the back of it.
Exactly, which would be probably more sort of ongoing, continuous monitoring as opposed to, say, a quarterly review, and your quarterly review would then pick up things like your financial promotions and your less static, regular activity that needs to be monitored. But I don't know that it's quite as polarised.
So what we're sort
as
of
you suggest.
envisaging is, at the moment, the market is a sort of price-sensitive market. Most regulatory hosts will just take on ARs at a price. And as an AR, you're going, I like that because it's good for me to raise funds because I'm with them, or I don't really care about regulations, they're cheap, I'll go with them. What you're sort of envisaging is, if I am this strategy, I go to those guys. If I'm this strategy, they're more appropriate. And it's less to do with absolute price and more to do with where you find a home. And there'll be a couple of mega ones, IQ, EQ, that's saying, we've got the heft to do VC and private equity and trading and credit. And then there'll be a whole load of boutique ones. You go, we're profitable on 10 or 15, but all we do is this with all the risk management add-ons and the rest of it.
And the reason
so the market's sort of going.
The reason I say that is because, as I say, with a slightly broader perspective, having just returned from Asia, we see regulatory hosts in other jurisdictions. In Asia, for example, there's no principal AR framework in the regulatory framework in Hong Kong and in Singapore, but we see regulatory hosting as a business model, as a service that has developed in the market, sometimes quite specialist, sometimes just for hedge funds, for example. But it's there because of a need, because of demand. So I think that's, sort of trusting the economic market functions.
Yeah.
That is how I would envisage that the market will end up as a mature market.
And Andrew, as somebody that's running one, you can tell me if I'm talking rubbish. Yeah, goes without saying. You can explain where my thesis is incorrect, I'm sure. What's your take on it?
Well, I think there are certain things that apply to all reg hosts. So I'd come at a different angle to Rebecca in that sense. I can't see how a reg host can manage the conflict inherent in the business model if the CEO and the SMF16 are one and the same person. So I think there are certain minimum standards. I can't see how you can do effective monitoring if you don't do a risk assessment at the onboarding, and identify all the risks so that the monitoring, addresses the risks. I think you have to do. I mean, quarterly is the norm, and you may have some variance depending on risk. It could be less frequent, 6 monthly, if it was a low risk AR. But you have to have that structured, periodic monitoring, and you have to have working papers and findings from it which you repeat. So I'd say there are certain factors that are minimum standards. And then there are things that are the risks of the day, like sanctions risk, for example. So in our case, we've got this, onboarding technology called Max Comply. So as you come onto onboarding, all the individuals as well, all their KYC and all this stuff, they're screened at the beginning. But because of what's happened with sanctions risk, we now do overnight screening on all the UBOs of the ARs. So, that's 200 or 300 people if we've got 100 ARs and it's 2 UBOs. All the approved persons, that's about 600. So you're getting up to about 1,000 entities there. So you have to have technology. So, we've invested in the technology. We do overnight screening. If someone goes onto a sanctions risk, we know within 24 hours.
And what action do you then take? They go on a sanction list. Do you take them off your platform? Is it 3 strikes?
Well, you get a hit saying that someone's, say, a Russian national. So then you have to look into, is their father on the board of Gazprom? Did they get their money from, Is that how they? So you got to do an investigation. It's not black and white. But you need the technology to identify what you've got to investigate, and then you have to do it. And I would say, but this is a more controversial view that I have. If you're not doing that in this environment, overnight, checking whether the UBOs of your ARs or your approved persons are going on a sanctions list or not, then that's a minimum standard now in this, in 2022. And I'm not convinced a lot of reg hosts are doing that. So I'd say look for that when you go in and do your investigations.
And what other minimum standards? Easy for me to say. Which other minimum standards would you say were important?
Well, the other one that you'll like this one. The other one that was in the 2018 thematic work was market abuse risk. So. Right. I mean, we have a hell of a lot of fund advisors and private equity funds where the fund's in Guernsey and they're just making recommendations on investments to a board in Guernsey. But if you're a hedge fund, if you're doing the hosted AIFM model where, the AR is advising a manager who's seconded in to the AIFM, then you have to have a market abuse, systems and controls. And the FCA said that in 2018, and it wasn't acceptable not to have automated, technology to do this, and it wasn't acceptable to do it manually. So I thought they kind of set that standard in 2018 for hedge funds that are on regulatory hosts.
So I'm glad we've dived off this way, because one of the things that I think is an absolute killer in the policy guidance for existing ARs is effectively the question, in inimitable FCA style: do you agree with our proposed guidance? That's the FCA, not mine, obviously. Our proposed guidance for principals overseeing individuals at their ARs to a comparable standard as if they were directly employed by the principal. The FCA says, yes, you are going to need to take your ARs and take them as if they were employed. Now, I used to run the IT for a hedge fund, multiple hedge funds, and we tracked employees logging in, logging out. We tracked their data access. We supervised their email and phone calls and all the rest of it. If we're taking this point seriously, does that not put a massive increase in both the cost and the governance and the management of any ARs? Because the FCA is reasonably clear here that ARs should be treated as employees of the firm, as if the firm has the purpose of what the AR is doing. And I'm just wondering if the ARs actually understand the intimate business models of being a hedge fund. But you do, right? You regulated them. But what we're saying here is that the regulatory host knows how to be a VC, knows how to be a hedge fund, knows how to be a high-frequency trader, knows how to be an investment manager, and treat the employees likewise.
Well, I think if you're seconded
I shall
into
take my glasses off
if you're
now.
seconded into an AIFM and you're a hedge fund, I
But
think,
this
yes,
isn't
it's
just
clear
that.
cut,
This is
yeah.
clear. It's ARs.
Yeah,
right? This isn't
I
seconded
it's
in.
not
That's
it's, for this kind of scenario where you're an AR of fund advisor to a PE fund that's in Guernsey. So you might be venture capital, for example, and you're sourcing ideas, you're researching them, you're building up due diligence, getting all that data, then you put it all together into a pack, you present it to the investment committee in Guernsey. I don't think in that scenario it's generally accepted that you have to treat those, typically there might be a dozen employees of that AR that's a fund advisor, as if they were, employees of a hedge fund, say. Now, we
Why? I mean, you were a regulator. You invented the regulation of hedge funds, pretty much.
Yeah.
And I was working for a hedge fund at the time,
Yeah.
and we were a sub-delegated investment manager, and we had to keep records and control and all the rest of it because we presumed that was what the rules were telling us to do as a sub-delegated investment manager, right?
But when that team brought on the private equity managers, I mean, we
private
did
equity is
supervise
different.
them.
They've got some super lobbying that means that they don't have to follow anything along with VCs.
They only
But
trade
everybody
once
else,
a year rather than
and they've got a whole
minutes.
load of professional
Yeah.
advisors in the
The
chain,
risk
right?
is very different.
Yeah, but for the other bits of ARs where you do have principal trading, investment suggestions, whatever, CES 10A doesn't have a proportionality to it.
I think if you're a host, if you're a hedge fund hosted AIFM client of a principal firm of a host, then I would agree under the hosted AIFM model, yeah. And you're trading in liquid instruments. I think you can read that the way you want.
So we're now
and I agree with
suggesting that Rebecca's thesis around it developing into very targeted, industry-specific type regulatory hosts makes more commercial sense when regulatory hosts have to take on that risk.
Well, it may have a different price tag attached. So,
Yeah.
I read the statement that you've just read there in its pure form, and I think it is correct that the principal should be treating the ARs as their employees, because it's, for me, back to why are you doing that? Because of the risk.
Yeah.
So you talked there and you mentioned the mitigating the cyber risk, mitigating, what you have to come back to, why are you doing these things? Why are you logging people in and out of the building? Well, because there's potential risk exposure there. If they're going outside with a mobile phone and undertaking some PA dealing that they shouldn't be undertaking.
Or if they're using WhatsApp
Exactly.
as a channel that's banned.
Because whose risk is it? It's the principal's risk.
Yes.
It's under their
Yes.
authorisation.
Yes.
So therefore, how much money do you want to spend to make sure you're mitigating that risk? I think is ultimately the question that you're asking.
And where do we think the crossover is then if this is the case, because obviously for some industries it is, some industries it isn't. Sorry, other way around. Some industries it isn't, some industries it is. There has to be a crossover between now being an AR, if you're going to be treated like an employee and you've got all of the systems and the processes and the rest of it, versus becoming sandboxed through the FCA or even directly regulated. Do we think that that's lowered the point at which a fund coming into it may go, well, if I've got to do all of that and pay for it from a principal, I may as well, sorry, a regulatory host, I may as well just go and get regulated myself. Do we think that that's a subtle FCA drive to get more directly regulated firms that otherwise would have gone?
I don't think that's where the regulator's coming from. I think that, so I've spoken to clients who are considering going on a regulatory hosting platform, so a new emerging manager considering going on a regulatory hosting platform versus going for their own authorisation. And I think there are lots of different factors at play, actually. For example, are you targeting an institutional client investor base, I should say? Well, then you want to be, looking as big and grown up as you possibly can from day one, so more likely to go down the regulatory hosting route, which might also open up access to potential institutional investor base from day zero. So I think there are many different commercial factors at play. The regulatory piece is obviously a big one and an increasing one, but I think there'll be other reasons why there may be different options in the market.
So that's a very interesting thesis that is driving regulatory hosts into the same place that prime brokers were about 10 or 15 years ago, where you were choosing your prime broker not just because of the deal, but because of the fact they could introduce you to capital or they could put in processes. Is that something that you guys are looking at in ancillary services? You come to IQEQ and X, Y, and Z, we will introduce you to our, I don't know.
We do everything.
Okay.
So that is the whole thesis behind IQEQ. So a private equity fund, you know, if they come on as a startup to incubate, and we're seeing this a lot of our clients are like this. They'll bring us on as a fund admin, so we cut the NAV. Do the investor KYC when they launch. We can provide them with DEPCO. If they're a US manager, we've got compliance consultants in the US and Asia. I mean, we do it everywhere, basically. So nearly everything that a private equity manager or a real estate or a green infrastructure fund, because that's a big growth area, would want to do, bar choosing the investments and, communicating with investors, we do the whole lot.
So
that is what we're doing.
You're not going near cap intro then?
No, we don't do cap intro. No, that's the prime brokers still do that on the hedge fund side. I mean, we do lots of training around how to do a pitch. And in fact, we've got an initiative at the moment for sort of gender equality and encouraging female GPs and founders. So we've done a lot of training with others around how to do your pitch deck, how to target investors as part of that called our Elevate program. So we do venture into that a bit, and we do advise people a bit on marketing regulation. But again, some of that goes over into where they'll rely on legal counsel. So you still need legal counsel to do the fund docs and advise you on some of the finer points of marketing regulation around the world and that kind of thing. So I'm slightly exaggerating. We don't do everything, but we can reduce the number of outsourced service providers you need by a material amount and make your life as a COO a lot easier.
It's not quite fund in a box or hedge fund in a box.
No.
There are definite bits and pieces that I, as a potential client, would need to bring to the party, the money and the strategy.
Yeah, instead of having a separate DEPCO, a separate fund administrator, a separate compliance consultant, separate, host if you want to incubate, another compliance consultant if you go to the US. So we've rationalised all that. Yeah. But there are still other providers you need. Yeah.
And back to the advice channel, if I'm making my decision on all of this and we get to they're asking me to give up all of my data, sit there, have my email looked at, my voice calls done. I've got to put this fleet management control in for all of my devices. And it's beginning to expand. I'm an AR firm. I've got 10 people here. I thought it was only one of me. Now it's 5 of me. Where's your advice mind going in between the, well, actually, that's onerous, you should get directly regulated, or no, try it there and then see where the regulation comes? Where's your advice channel?
I don't think it's one size fits all, actually. So when we advise such clients, we very much understand holistically where they've come from, what they're trying to achieve, who their target investor base is going to be, what strategy they're going to employ. So we do a lot of data gathering before we would say, yep, go down the authorisation route or go down the regulatory hosting route, because I think they're quite different. I think with the increase in scrutiny that is coming from the regulator, it's going to push up the cost of the regulatory hosting service generally.
Andrew, stop smiling.
If it hasn't happened already. So therefore...
So you mean gone are the days where it's 38 quid a month?
Just at a pure cost, looking at the cost element, then I suspect that going down the direct authorisation route may be cheaper. But there are other factors at play making the authorisation more expensive.
Well, there's speed to market.
The length of time to get through the authorisation process with the regulator, for example, which is quite topical. And being able to get through the rounds of questioning from the case officer when you go through the process. Is
and
quite
how are we, that is your day-to-day, right, advising people on becoming regulated. What does that feel like in the market at the moment?
It's tougher than it was before, definitely.
Okay, and how long, what time are you seeing to get regulated?
It's very topical. Came out in something in the Times today, I think, that the regulator has admitted that they failed to hit all of their target timelines.
I shall try not to look shocked.
So net result is it's taking longer, and
do we know about how long? Is it 18 months, 12 months?
It's hard to say on average cases, really, but yeah, I think we're looking at 12 months mark, maybe a bit more. Yeah.
So I guess the advice is get yourself hosted, get the business model working, put in your application at the same time.
Run them in parallel.
Yeah.
And I think that's an important point, because I mean the industry is always big selling point has been speed to market, which is still going to be true. Although, you know, it's the individuals that need to get authorised that slows things down. The AR, I don't think everyone understands this. The AR can get approved in a few days. It's the individuals which can take 6 weeks if you're lucky. Sometimes it can go up to 3 months. So that's the speed to market advantage. But you know, I'd agree. You know, 9 months if you're really lucky. Probably more like 12 from you know, engaging your compliance consultant. More like 12 is. So you still have that speed to market. But I think we've got to change the message a bit and say it's more about institutional quality compliance support from day one. You know, because the reality is a lot of you know, founders, startup, they don't have the money to even afford a full-time SMF 16, let alone all the other stuff that you need to do compliance from day one. You know, and they can get a compliance consultant to do the manuals and get support and everything, but you do need someone who's competent enough to do that role, and that's not always easy to find. Whereas if you come onto a host, you know, you've got that institutional quality compliance from day one. I mean, there are, you know, there might be a really successful trader from a bulge bracket investment firm that can get some backers, and you know, there's a seed investor in the manager, there's a big seed investor in the fund. You know, they can afford to hire 15, 20 people from off the bat. But you know, that's
few and far between.
Yeah, that's not typically. I mean, a lot of.
If you hear of those people, I've got a service for them.
They can go straight to direct authorisation if they want, but. The majority of founders, you know, they have a dream and they have some money and some backing, but they're much better off, I think, in a lot of cases to come on, incubate for a few years, see how it goes, you know, get the fund track record, get the capital together, and then go for direct authorisation.
And so we're coming back to the idea that regulatory hosting is a sandbox that is just outsourced from the FCA rather than running a sandbox.
There are certain types of asset manager. You know, like if you're managing a listed fund, for example, which we're very big in, might make sense just to stay on the host forever. You know,
You said that with a straight face.
Yeah.
That's amazing.
I think if you're a hedge fund and you're successful and you get
Yeah.
really
Yeah,
good
yeah,
AUM, then there's you get to a certain size where the AUM's you're too big for a host and you need to get direct authorization.
I think there's an
Sorry.
alternative, which is having a great compliance consultant giving you good ongoing support. So go down the direct authorization route, and you don't, there may be a great founder, but there may be somebody who's got some compliance knowledge and experience, supported by a great partner, compliance consulting firm. You can achieve the same aims.
So interestingly, the market in America is much more that way. So in the UK, you can only be an SMF 16 of a firm or a group company, 2 or 3. In the US, you can be the compliance officer, loads of different things. So the outsourced CCO model, okay, they have a rules-based thing. They have 3 rules. You need policies and procedures. The compliance officer makes sure the policies and procedures work. You have to annually review your policies and procedures, regulated. And I think that's also an interesting competitive model. So I hear what you're saying, Andrew, about we, in terms of the regulatory hosting, are able to offer a very good regulated service that has provenance and the rest of it. But the US is going down a different chief compliance or outsourcing market, where as a firm, as long as you've got one of these people, you're regulated, you're off, you're going. Okay, there is a set of procedures and stuff, and if your CCO knacks you off, then you're gone. But there is a different way, which plays more into the consulting approach to...
Yeah, no, I agree. I mean, we're one of the biggest players in outsourced CCO in the US, and that's a consequence of the regime. So registration is fairly straightforward compared to authorization. And they don't have approved persons, they don't have senior managers regime. So, you can use an outsourced CCO there, you don't need a host, particularly in the US. But I would turn that round to the FCA. If the FCA want this kind of high bar, gatekeeper role, and this big intensive authorization process, then you need the regulatory hosting model as well. Otherwise, you're really going to damage the asset management industry. In the UK. So I think the FCA need to understand that if they want to stick with, and every sign is that they like this authorization, and it has the levels of fraud, in the UK hedge fund industry are tiny compared to what they are in the US. This is something I found in the paper I did. So I support it, but the FCA need to understand that if you have that big, narrow gateway that takes a long time to get going, that you've got to have the regulatory hosting option as well. And I agree, for some, it depends on circumstances. If you've got fans and friendly, friends and families who are going to invest in your fund and get you to a certain size from day one, maybe you don't need the host in those circumstances. You
do speed to market
direct, I mean, we do both, so I don't have an axe to grind on this either way. I think it's all about having a grown-up conversation with, the provider and just going through the pros and cons of each approach.
So, Rebecca, we've highlighted UK, US. You've got a heritage in Asia. With your Oriental eye, what do they do that we don't? Are we missing a trick that we could learn from over there, or?
So it's interesting, as I alluded to before, there are regulatory hosts in Asia markets.
And are they the same as regulatory hosts as we would understand them here? So they hold the regulatory purpose and you rent it from them?
Yes.
Okay.
Yes. And I don't think it's as big a market, and I don't think it's as developed a market as we see in the UK, for example. But it exists, and it exists through careful contracting and putting individuals on the license of what we would call the principal here on the licensed firm.
Okay.
And as I said earlier, I think it's emerged because there is a market demand for that type of service, and it is very much focused on the investment management sector. So it's for supporting the emerging manager, and it does pick up on the same benefits of speed to market, giving you access to good compliance, where it's a high quality provider, and therefore, the manager, who's usually, say a star portfolio manager coming out of another house, has the ability to do what they do well, as doesn't get distracted in the early days with dealing with all of the infrastructure and the compliance and the operations that they need to support it. So usually they come as a package: operational support and compliance support, and it's packaged.
So
up
it's
as a
more
service
like
there.
renting a desk within
Yes.
an arcade than it is I'm running my own firm and I'm
Yeah.
just seconded that person
So
in.
interestingly, we did pick up on, I think the regulator is also, because they learn from each other globally, starting to have a look from a supervision perspective at some of these business models.
Right.
And so we saw behind the scenes the regulators reaching out to these service providers and asking questions about their setup and their model.
And remind me, because I have a poo-like brain on these things. Asia are principle-based or rules-based as regulators generally?
I think we would call it more principles-based insofar as there is not the volume of detailed prescription.
So
of
it's
rules.
more likely to go for a regulatory hosting model than a chief compliance as a compliance outsourcing model, because that strikes me as being very rules-based. If the rules are right, then you can do it. Whereas the principle-based thing, the regulatory host seems to be more in tune with a principle-based regulatory.
Yeah, and I'd say then the art of compliance is more about meeting the regulatory principles, but also market practice and good market practice. And the regulator expects to see the good market practice in place.
So
in Asia
does that
it's
mean you
different.
see the vendors from there coming this way and doing well, or do you see the vendors coming from here going that way and doing well?
Interesting. I think probably we've seen a bit more of, Bovill have seen a bit more of vendors coming and doing well out in Asia and taking that model.
Right.
And
And
that
why do you
idea
think
out
that
to
is?
Asia. I think just because of the maturity of the service line and how it has matured here and it's been taken out to Asia, is my perspective on it. Also, just to add in, I probably have quite a skewed view from the sort of Hong Kong, Singapore perspective.
Right.
So sort of seen it from that.
I remember
that
taking
view.
a fund through MAS regulations, and we had a cloud infrastructure, and it took years off my life. So
But the regulator's much closer to their licensees there.
they are, and it was
So-
nicely rules-based. So if you
Yeah.
could satisfy the huge great due diligence sheet that you had to do for MAS, and you had an answer for it, and it came down to, I had to go to Azure and say, listen, I can't get regulated unless you give me the address of your service centre. Never want to visit, I just need it for the form. Because without it on the form, I'm not being regulated. And that would, because it was interesting you saying they're principle based. So no, there was a big spreadsheet to get
The
these.
published rules are principles based.
Yeah, okay.
The expectation from the regulator is probably a bit more
Very
market
detailed,
practice.
yeah.
Yes. Because it's more close and continuous supervision. So in Hong Kong, for example, you are visited sort of every 7 years by the regulator, regardless of your size and shape.
Yeah.
So it's a very different setup.
Right, it's come to that time of the day where we have questions. And as my iPad is about to die, I should ask those questions before the screen goes off. So, Mr. Kevin Taylor, I'm assuming his gender, sorry, Kevin Taylor, is asked a question. What is expected of the AR when it comes to meeting the October deadline for an implementation plan under the consumer duty? Now, I haven't got a clue. So I'm rather hoping that you do. Consumer duty is a compliance thing, not a tech thing. So yours.
I think Rebecca should start. It's more a retail thing, but
Oh, it depends. He hasn't said what
I
type
think
of
that's
AR.
a hospital pass, isn't it?
He hasn't said what type of AR he is.
He has not.
There is an obligation. I think the obligation sits with the principal firm, but there is an obligation to have a plan for consumer duty.
Surely an
it's
AR
interesting.
doesn't care, though, right? The reg host
Well,
goes, this is our consumer duty, this is what you're doing.
I think it's good that
isn't
they
it?
care. I think it's good that they care because
no, yeah,
they
yeah,
have to
obviously
be
they care, but-
involved in the formulation of a plan, because it's back to this mirrored language in consumer duty and the policy statement in terms of determining what is the potential harm.
But isn't the joy of being an AR that you just go, I'm paying you to do that, you tell me what it is, and off we go? Isn't that, or am I missing something it's entirely possible I'm missing something fundamental in this relationship. But I'd have assumed as an AR, I'm coming to a regulatory host and saying, consumer duty?
No, you're right. I mean, a regulatory host, again, I mean, you could ask this as a due diligence, how do they track regulatory change? Because you've got consumer duty and all kinds of things coming
What is
in.
consumer duty, by the way?
It's like,
do we know?
You would call it treating customers fairly, reheated, being cynical.
Okay.
But it's a brave new thing that's going to protect retail, and
good.
That's the hope.
Good. They'll
It's
like
very,
that.
very principles based. There is a point actually. I think there's an exemption if the minimum investment in the fund is £50,000 or more. So that excludes a lot of our ARs. Having said that, we have some listed ARs, so I mean we will advise them on what it means for them as part of the hosting service.
Okay. And there is a second bit, which I guess is actually the answer to the first bit, which is what should the principal be doing in terms of overseeing the AR's compliance with the consumer duty?
So it will be in our where it applies, then it'll be in our monitoring, and we have both a monitoring team, and we also have an advisory team. So our advisory team will, put out materials, and we do annual training. So there'll be slides about the consumer duty in the. I mean, it's more frequent than annual in some cases, but we'll be in that training. So there's always a section on regulatory change. So we'll be explaining, consumer duty on that. Actually, that's another technology issue. We put in technology to deliver training now as well, because that's
good.
That's very hard to manage.
Yeah, absolutely.
And as you were pointing out, if you've got lots of individuals,
you need to attest to all of that stuff.
Yeah, I mean, if we've got 100 ARs, and I'd say on average, is there 6-7 person PRR? You're up to 700 people. I mean, it might be higher than that. It might be more like 1,000 people. We've got to train at least every year.
Yeah.
So so we're using technology for that. But we would, to answer the question, we would have slides on consumer duty in that training.
Rebecca, what consumer duty for your clients that aren't ARs? Just as
it's like the biggest thing.
There you go. Just if you've got 2 minutes and you could tell us, that would be great.
Where to start? Well, I think it depends. Again, I'm going to give you my terrible politician answer, which is depends which part of the market you're in, because consumer duty is about the next generation of TCF. It's about really assessing where the risk lies and being very honest about where the potential harm for retail investors lies. So I think on that basis, I'd give very specific advice to the client, gentleman concerned, but I don't know if it works on a
So I think it's fair to say to Kevin, he should come and talk to you.
Definitely.
And see what it is, right? And the details will be in the bottom of the screen right now, if we can.
Yeah, and if he's an AR,
and if he's an AR, go to IQEQ,
and his host is not training him on telling him what he needs to do for consumer duty,
I think,
come and speak to me.
Yes, and if you want email supervision or any form of policy-driven supervision, come and talk to me. Brian Gray asks, does the panel have any idea? Sorry, new line. Does the panel have any idea what the current FCA approval period is for taking a new AR? And in light of Kevin's question above, is consumer duty extended the period? How long does it take you to onboard people? I think.
Well,
is
the AR is very
there.
fast, so they do that in a few days.
But they can't trade until the people
They can't
are there.
do anything. This is the point that I think there's the nuance that needs to be understood. You can't do that until you've had your individuals approved.
Yeah.
So.
Can they start doing once they're an AR, can they start doing fundraising before the people are approved?
No.
Or do the people need to be approved before they undertake the regulatory purpose? Okay,
Exactly,
sorry, do carry on.
So, on the best case, we find it's about 6 weeks.
Right.
The statutory minimum is 3 months.
Okay.
And sometimes it does run over six weeks. And it all depends whether you fill the form in correctly or there's anything finding. Whether have you had a CCJ? Have you been involved with a firm that's gone bust in the past? Any criminal record? That's usually for driving. Points. Yeah. And beyond that, and the screening. Obviously there's a whole sanctions issue as well. So.
And how about AR references? If an AR is moving from one host to another, and you now have to take and give AR references.
Yeah, that's a good point. That is a problem, actually, getting the reference. So, I mean, sometimes we keep chasing the previous AR, and there is a sort of reasonableness thing that if you just can't get it out of them, you put that on the form to the FCA, you know, and then the FCA can see that as a regulated firm's not providing the regulatory reference. So that can slow it down, but there's a point at which you say, right. So I'd say assume 2 months. That's probably the average.
Perfect. As we've understood it to be about 12 to 18 months if you want to be directly regulated.
And I would say sometimes the speed to market thing's a bit oversold. It is actually 2 months versus 12.
Right.
That's the
and how long to
balanced
get into
truth.
the regulatory sandbox?
That's
Because that's an alternative route through, right?
Yeah, I mean, in that fintechs, they give you a lot of support, but you don't get authorised till the end of it. I think they've done about 550 fintech firms since 2016. So it's slightly different. You know, my point was that the outcome's the same. You know, second in the world for fintech, second in the world for asset management.
Yeah. So I do have another question from James, which I don't know is my marketing department saying it's me or whether there is somebody called James that asked this question. Do you see the reg hosting business model being a sustainable offering, considering the policy guidance and the continued pressures from the FCA?
Yeah, I mean, I think if you get scale...
you think it's a scale business? Because earlier we were discussing that it was a specialism business. You could
I think there's going to be a small number. You know, I don't know what it is, maybe 10. And we have 2 principal firms. That might be 20 principal firms, maybe 10 groups that go for the scale model. You know, and I mean, we've got 100, and in investment management there's 1,000, over 1,000. So, yeah, maybe you have 8 with 100, and then there's 200 who have, you know, specialist providers or just a single AR of a friendly investment manager. That's the way it's going. I mean, I think if you get it right, I mean, we're gaining a lot of business, and you know, we can make it work by scaling. I mean, using technology to enhance the monitoring, and some of the monitoring, you know, like delivering the training through technology, doing the screening through technology,
doing the policy-driven supervision, maybe.
Market abuse monitoring. That's all done through technology. We're also expanding our Newcastle office as well. So yeah, I mean, we see a fantastic, you know, bright future for us with it, and I think others will see, you know, that they can make it work, but definitely it's going to have to be consolidation to make it viable.
Rebecca, your market model wasn't the same as that, as we were discussing earlier.
I think there's some good boutiques out there, and I think there's still space for the good boutiques in the market, you know, that have really good proximity to their ARs, know them well, good oversight over them.
But in a specific industry vertical.
Exactly. Yeah. And I think that will continue. I think there's space for that in the market. I think they've got good efficiency because they've got good expertise and knowledge and oversight of those particular models. So
maybe we'll just be the scale one, and then there'll be a series of boutiques.
I think that's where we're going, right? Because if you are specialising in credit insurance or whatever, then you have a whole tooling and a understanding of that market for oversight, that you maybe have one client that does it, and if you've got a boutique that has 20 clients and that's all you do, you're going to get the economies of scale in that you might not have elsewhere.
And you'll love this, James. The technology enablement, I think, gives you the efficiency.
Yeah, I fundamentally believe that.
The other point that we were discussing earlier, James, is that apparently private equity money has lost interest in investing in the sector because of it seems like the consultation paper and new rules are the straw that's broken the camel's back, and they've just lost any appetite in investing in it when they had been investing in it. So it's only going to be groups like ours, which have a big parent, it's part of their group strategy, that are going to invest in this. So that's going to drive consolidation as well.
Well, also there is natural fatigue, right? The venture capital private equity comes in waves. There are a number of aggregation plays at the minute that are coming through. We can say it's a 3-letter, begins with early on in the alphabet, and they're private equity backed and they're hoovering things up. You guys are private equity backed and you're expanding. There are some more 2 or 3 years out with private equity backers. I'm sure there are some more further along. So I think all this is a pause while the existing venture capitalists, private equities are digesting what they've got, and the next ones are thinking, well, just see how this market shakes out. Because it makes a difference to a private equity. They maybe don't want to buy the one-stop shop, but they maybe would want to hoover up a whole load of specialists to make a one-stop shop. But until the market shakes out that way, they're better waiting and saying, well, what those big ones are going, see how that goes. But actually, we now need the market to reform under these new rules, and then we'll hoover in 3 years' time, 4 years' time.
Yeah, that sounds like half a dozen players going for the scale, and then boutiques with the rest.
Yeah, I can certainly see if the market, and I'm with you on this, I think there will be some very specialist vendors that take 10, 20 of them and really know it and understand it. And yeah, some PE guy will come in and go, I like that, I'm going to make another Beamoth over here with 100, but I'm going to take all these specialist things, knock them together and see where it goes. I can see that as the next model if the market goes the way that you and I think it goes. Have a final question from Adnan Siddiqui. How does ICARA translate to customer duty? What's ICARA?
Prudential.
So anybody look up what ICARA is? If we knew what that was, we could have an opinion. You do know.
Bring my
Of course you
Prudential
know.
team with me.
There we go.
So you get a very basic 101 answer from me. But I think that's a very difficult question. I think if I had a bit of understanding of what sector we're talking, then could probably give a more meaningful answer.
Which sector could you give the best answer for? Let's imagine that I've just set up an investment manager. I don't know what an ICARA is, so maybe it's not even applicable in that area. I think the answer is we don't know.
No, the ICARA is your assessment of your prudential risk.
Oh, okay.
So it's bringing into play the prudential risk assessment in that consumer duty piece, I think is a sort of general sense here. Again, I'd say point the question specifically and we can have a conversation to understand what the type of business model is.
I mean,
am I allowed to say who he works for? I know it's just appeared here. No. Okay. But that name doesn't give me any idea what they do.
I can answer on the hosting side. So,
please.
So we have two principal firms, as I said. One of them has a MiFID permission, Sapia.
Right.
The other, G10, has a MiFID top-up permission. So they both have to do ICARAs. So, that's all about listing out your risks, doing scenarios.
So is it like a Pillar 3 disclosure?
It's
an ICAP,
it's like consumer duties, TCF enhanced, then ICARA is ICAP.
Oh, okay.
Enhanced.
So it's the stuff you have to publish about your financial stability and that sort of thing.
Well, it's more the risk. There is capital and scenario planning for capital, but it's more about identifying your risks, quantifying them, doing scenarios.
Okay.
So it's a bit sort of like banking prudential obligations, but for investment firms. So it's a slightly more advanced version of prudential risk assessment.
I think the answer is regulatory hosts have it nailed because they have to have it nailed. And if you want to know about ICARAs, then talk to Bovill because they understand
we've got a great team.
prudential regulation, I think, is the summary there. So that's it for today. I would like to thank both Rebecca and Andrew for joining me. Thank you very much indeed. It's certainly for me, I've learned a bucket load, but I know it's not about me learning, it's about these people learning, and hopefully they've learned too. And I'd like to thank everybody that watched the webcast that we've just done, and we will be back in another month or so with another shift panel on, hopefully, subjects that are of interest. Yeah. Thank you very much indeed. Goodbye.